Hey guys, so grading market conditions super important. Let's have a look at some things that we do with our underlying market checklist. So we kind of had the filters or the technicals and the fundamentals. Now we're kind of looking at the market, right? Because again, with the price action approach, we're looking at everything. We want to take into account everything that passes the filtering criteria. So we want to make sure that what type of market are we in? Are we in a trending or rotational market? Because we don't want to be taking a momentum ignition strategy in a rotational market. Now, that's not to say we haven't come out of rotational market and into perhaps trending. That's the whole point of momentum ignition. But we also don't want to be, this is why price position kind of will precede that anyway, and we'll give you an alert and say, well, no, because we're still in the 52-week range, we're still in the quarter range, despite it breaking out of a weekly range and looking like it's super aggressive. The higher time frame doesn't really care. The bigger money doesn't really care yet. So also, we want to look at whether a market is naturally a trending or rotational market. Rotational being kind of range bound, not so range bound, but kind of driving up and pulling back deeply and driving up and pulling back deeply. It may still go from A to B, but it does it in a much more wavy manner than a trending market, which may be a bit more aggressive. And I suppose you could have a third one in there, which is like explosive. So the underlying market condition is super important, because we don't want to try to hit, a round peg in a square hole, or a square peg in a round hole, whichever way you're looking at it. And actually depends obviously on the size of the peg, doesn't it? But you get the point. That's a common phrase. We don't want to be using a rotational type trade in a trending environment, because we're just going to get completely wiped out every time. We don't want to be kind of selling new highs, trading exhaustion, what we believe is exhaustion, when the thing's just chugging slowly in a trend. We don't want to be trying to grab onto momentum ignition when we're just rotating back and forth and we haven't really got a true, genuine momentum ignition. And then the volatility of the market, guys, important from a risk management perspective, important as well from a trade management perspective. If something's super volatile, it might not pass our criteria for filtering. It might just be too much. It might be too much, or it might be perfect, or it might not be enough. So, volatility, I know I've had phases where in trading specific markets, they've been very good. Then the kind of volatility is compressed so much, it's not worth trading it. The opportunities you get were so limited, it's better off going on to another market and becoming a specialist in another market. So volatility is super important. And news flow. What I mean by this is, if a market is very much moving just on news flow, an example would be Brexit for the pound. So after the kind of vote of Brexit and that's all gone through, the phase of it sterling just moving based on news for, against, whether the negotiations are going well, it just becomes a news flow type market, in which what I mean by that is your setup could be the cleanest thing ever, and it's chugging along. The next thing is another bit of news comes out that's bearish for the pound and causes that to move against you, and you get stopped out. So being cautious that news flow is helping, not hindering. Now, of course, there are setups and strategies that we do that are based around a catalyst of news. That's different. But if you're constantly getting news, like good news, bad news, good news, bad news, these guys are winning, those guys are losing, this is going to happen, that's going to happen, and it's a flow that's kind of just a phase that you're going through in that market, then you might want to say, well, you know what, that's not really the type of thing I want, because actually, it's affecting the market too much and it might well catch me out. So, trade grading. Let's have a look at some example trade grading for a long momentum trade idea. Just picking the long momentum, obviously flip on its head for short. So let's, and also we'd adjust this obviously if it was our exhaustion trade or something a little bit different. But let's say we're trading a long momentum ignition trade idea. So our thumbs up or our pros would be, all right, we've got a good daily range. So this is kind of from almost a day trading perspective, okay? So we've got a good daily range. The signal is forming early on in the week. So the range is generally good, i.e. there's chance for this thing to move. The signal's forming early on in the week. So we're not getting it later where we don't expect there to be much follow through, or perhaps if we're day trading, we don't want to hold over the weekend and have a risk coming out. So the signal kind of gives us indication that perhaps bigger money is pushing money into the market, buying up this asset on a kind of Monday or Tuesday, and we think that maybe that's going to push through. We might have a little bit of a pause on Wednesday or Thursday, but the idea is that it's not too late for it to kind of do what it needs to do without us taking any weekend risk. We've got no upcoming data, so we haven't got to worry about coming out just before the data, which might end up doing all the good work. Fresh air until the target. So that could be, let's say we've got a price target. Let's say our price target for hypothetically is 100, whatever that may be, whatever market we're trading. The point is we've got a lot of room between the price now and that kind of really significant level. If we do have a price target, what we don't want is kind of a heavy resistance level, right above our heads. That kind of comes under the umbrella of price position, but still being careful we haven't got something like a whole number or something, that might well drag on it. We want that supply demand to be free, to be flowing, and in this case we want the demand to be able to come in and overcome that supply. Next one we've got is price already driven and pulled back. So we already want to see that the price has already given us that momentum trade. So it's already pushed hard, pulled back. It's already given the strength that we need. And again, we'll grade it on the technicals. We could say, okay, the kind of steepness of the drive. Yes, it's called drive. It's already pulled back and now it's going again. It's early, it's fresh, it's ticking those boxes. And we might have something like trap traders from last week. So that could be, again, hypothesizing and thinking, well, actually last week we did a lot of work to the downside and we didn't follow through to the downside. We kind of popped up on, let's say we popped up on the Friday afternoon and closed at highs and did a V-shaped reversal. And now on Monday we're opening drive aggressively off the open. We might say, well, that's good because the price position has indicated that a lot of people are trapped short from last week because they shorted thinking it was going to go lower. It didn't. It was really a fake out. It was really a kind of V-shaped reversal on the trend reversal day. This and this. What's the next layer? Right, that's the first filter. The next thing is this. Okay, it's got a good drive. It's past the filtering process. We're grading it by saying we've got a decent daily range. We've got an early in the week signal. The time position is good. No upcoming data. We've got fresh air to our upside if we take this trade. It's all good. Cons of the trade could be something like, well, correlated markets aren't moving. So we might say we're trading one of the European indices, the others aren't moving. Well, I think, well, actually, does that mean that this kind of those two are stretched? Doesn't necessarily mean the trade's off, but it could be like, well, it's not a broad move. We're not seeing the whole indices move. We're not seeing the whole Dow or whole DAX. US, Europe, Asia are all moving as a global kind of risk on play. We're just seeing one move, which might give us a little bit of caution. A con could be that news flows driving price. That's kind of going back to the point of, is it just news that's pushing it and it's not genuine people putting in bigger money to work. It's just scared money coming in and out looking for quick money, because we don't want to be a part of that crowd. We want to be part of the crowd that's moving big money. Again, that has a bit of more of a disregard for short-term price. And maybe the volume's average. So maybe we look at the volume and going, well, actually the volume's pretty average today. We want to see it, at least double. It's going to depend. The stocks, you kind of have 200-300%, but indices you may only see 50% more, 20% more. So be aware of that and look at that compared to your market. So there could be the cons, and there could be things that you say, well, actually, you know what, this is not a grade A trade. This is a kind of a grade B. This is kind of a grade B trade, and I like to use kind of A to D, if you like, or A to C. So stuff that's matching a lot of, and this is kind of stuff that you can do for yourself, for your own criteria. And depending on your market as well, grade A could be that ticks every single box possible and really strict criteria. So that's one that you go, let's say 3 times your risk. And let's say grade B kind of matches 8 out of 10 of those, and you go twice your risk. And grade C is just a trade that you take at just normal risk, that kind of give 50-50. You don't have any massive red flags, if you like, any bad things that really go against it, because they're part of the filter. Anything really bad should be in the filter. But anything that kind of goes, it's not great that, but it's still valid, it still ticks on my other filter boxes, I just want to go in as a normal trade. So something like that, or 1 to 3, or whatever it suits you. That's the way of grading it. It's kind of having the things that are important, weighting them, if you like, and then go so far as to weighting stuff. There's stuff that's very strict, of course, is in the filter, and there's other stuff that I'll kind of look at it and go, yeah, you know what, that is the really thing. And normally, the way it normally is most, 80% of trades are going to sit in your C level. And you might even have just 2 levels. 80% of your trade is C levels, and then you might get 15%, if you like, in your B, and then 5 in your A's. So A's got to really tick some boxes to go in, because there's no point otherwise in doing that. The point is it's a superstar trade that sets up very nicely for you and ticks so many boxes that you're like, well, this is worth 4 others, and that's the kind of good way of doing it. But again, if you're fixed position size, you may not want to do this. Your filter is your grade, if you like. You don't need to further grade it. It's filter, trigger, done. But grading just helps, I think, if you want to adjust your position size. All right, guys, that's trade grading.